And for our next session, I'm going to stick around. In addition to being your MC for the day, I'm also going to lead this next panel. And we will be talking about outlining a future for impactful investment strategies. So if I could welcome to the stage my esteemed panel, Tugce, come on up here. Adam and Ash, come on up. Give them a hand, ladies and gentlemen. Very good. As you wish. Do I need to introduce these people? You know who they are, right? Adam Kostyal, head of European listings at Nasdaq. Did I have that right?
Yeah.
Did I got that right? Tugce, who's having a drink. Now we were talking off stage. What is Angel Labs? What do you do?
Angel Labs it started as an angel network 11 years ago, and then it became a global platform of family offices that want to come together and in syndicates invest in funds. So what we do, in Angel Labs we have 600 family offices in 44 countries that come together and write big tickets into funds, okay. VC funds. And now I have a new VC fund called Hypernova, which is going to be announced in the next 2-3 weeks.
Well, I think you just announced it right here.
I mean, officially.
I mean, I'm all
yeah.
for an exclusive, so I'm loving it already. And we've got Ash from Lightrock. We had a conversation a couple days ago.
Yeah.
I mean, we could have geeked out for hours. Ash and I are big fans of deep tech. So we, a former engineer and a former opera singer. How that all happened, who knows? So listen, folks. When I don't know about you, but when I read the title for this session, outlining a future for impactful investment strategies, I was just as confused as you were. I don't know what the hell that means, right? So basically, I've been given free rein to talk about whatever I want. So, I mean, I've got 3 industry experts here, and as I said in our newsletter that went out yesterday morning, the newsletter that you are all subscribed to, right? The one that I author every week. Right, good. Okay. Nobody could have predicted this, but as we've seen in the past few weeks, the markets have, it's been a fun past 14
days. I think everyone predicted it.
What's that?
Everyone saw it coming. Everyone predicted it.
Well, I mean, you could see it coming if you know your history, but, anybody Bitcoin? Anybody Bitcoin? No? Okay, yeah, it's a touchy topic right now. So, I mean, 2020 and 2021 were, depending on how you look at it, a landmark, a banner year for European funding, right? Where do we go from here? What happens now? Things have been slowing down, and we've got let's just say a guide to the east kind of messing with things. GDP has been slowing down. What are some of the trends that you are seeing in conversations with folks around the ecosystem? Adam, do you want to give us your thoughts?
Yeah, I mean, I come from a different angle of the markets. We're probably at the later stage. So if you look at the US markets, we had only on Nasdaq last year 700 IPOs. So 400 companies and 350 SPACs, which was just a fantastic year considering 225 working days. It's pretty astonishing. And then in the Nordic markets, so I'm based in Stockholm. We head up and run and operate the Nordic markets, and Stockholm is our largest market there. Just in Stockholm we had 160 IPOs. We're not going to have that this year.
I don't think so.
No, but I think what is important is that I think when we talk about scale and we talk about platforms and for scaling, I think the exchange ultimately in the long run is a phenomenal platform for these companies to grow, and then they have to realign and adjust to the market sentiment. I think what's important right now is that from a public market perspective, we need to have alignment again. Readjustment, but we need to keep on investing. I think what Europe absolutely needs to keep on doing is to stay focused and keep on investing in growth, because otherwise I think Europe is going to fall behind. And that's what we saw back in 2000, and where US took a very strong role in Europe. And I think from a public market perspective, we need to keep focused and say that European companies can list here, can access the European markets, but the US markets will still be very relevant for many of the European growth companies. So overall, much more quiet market right now, but we're seeing a lot of interest, and we're hoping for a stronger Q3, Q4. but most likely we're talking about 2023.
Does that resonate with you, Ash? Tugce, what do you think? Ash, what do you say?
Yeah, I think so. We are a growth investor, right? So I agree with what Adam said, that most of our companies which are more on the IPO stage are probably planning to move it to 23, 24 because the markets are such. But on the other side, I also think this is a huge opportunity now starting to build, because the wave of digitization, which kind of accelerated in Europe over the last 10 years especially, has driven this adoption, which is building these companies which are really meaningful. And in that regard, I think this is a good time because this will separate the wheat from the chaff. There was a lot of noise over the last 5 years. There was so much of funding, and companies which needed to be funded were funded, but there was a lot of companies which should have raised capital also got funded. Now the companies which actually deliver value will continue growing. They're building big businesses, and you're seeing that in Europe.
Yeah.
Traditionally, you would see that a lot in the US, but now I think Europe has kind of matured in that respect. So we are seeing a lot of very high quality companies, strong growth despite whatever we are hearing in the news, and they will command strong valuations because they have very strong fundamentals. So I'm not overly concerned. Yes, there will be a correction in valuations, there will be a correction in multiples, which is a natural after effect. But if you're taking a long-term view, which is what venture is all about, I think these companies will become global leaders eventually. So I feel good at this point in time.
Good.
I second that. I agree with it. I think it's an opportunity, and also I think the correction is healthy. I think there was, as you said, there was too much funding, too much capital. As you said, the companies maybe that shouldn't have gotten funding was getting funded. I think the correction in the market is gonna push companies to focus on sustainable growth, and I think that's needed. Again, maybe one problem that I can see with growth stage companies, they might have to readjust their expectations when it comes to fundraising and going public, etc. I mean, I guess all entrepreneurs at all stages need to readjust their expectations because evaluations will shift. But I think overall it's healthy.
Yeah, yeah, yeah. Now, Tugce, I mean, you just mentioned going public, and I mean, we've got Nasdaq right here, so I of course want to bring this to the table. I mean, in your opinion, is this the be-all, end-all? I mean, should all European companies be looking to go public, or is there some value in not?
Well, in parallel to running, public markets, Nasdaq US and the Nordics, we also run something called Nasdaq Private Market, which is a really active secondary market, where basically companies are in complete control to manage liquidity on an ongoing basis. And they decide who gets to sell, who gets to buy. So I think liquidity is a key word here, because at the end of the day, if you're a growth company, you're not able to create liquidity in a structured way for your employees and for your early investors, you have a pain point, which is going to hurt you. Companies will leave, employees will leave. It's a retention issue. And it's also an opportunity to attract employees to create regular liquidity. Regular liquidity in the private market is not the same as an IPO. But at the end of the day, it's a part of the solution to stay private in a more efficient way. And at the end of the day, that gap between a late-stage private company and a listed company is very small in terms of maturity and the governance that is requested, because you start getting crossover investors that are very institutionally driven and that set very high expectations on the companies from a governance point of view. So I think the challenge that Europe has is that private market is not functioning. So you have a very fragmented European landscape from a taxation point of view, from a option point of view, etc. So you don't have a well-functioning secondary market. I think that's what Europe needs, because at the end of the day, it's not about all companies needing to go public. And we saw that last year. A lot of companies came into the market which probably should not be in the market, either through SPACs or through IPOs. And those are going to be tested. But if you look at it holistically, those two markets have to live parallel, private and public. They're not the same. They fundamentally add different layers of value. And staying private is not the solution for many of these companies. Ultimately, I think the IPO market will serve them better to grow that 10x. But you have to find the right time, the right valuations, the right partners, etc. And I think right now is probably not the right time to go into the market, but it doesn't mean that the market is gone. that's my fundamental view of this, and I think Europe is lagging on this structured secondary market, which would serve many of the European companies well.
Let's see what the VCs over here weigh in. I mean, is that? Yeah, I mean, you're obviously hoping for an exit, right? I mean, you ultimately have to return to your investors.
Yeah, no, but I completely agree with what was mentioned about the secondary challenge here. You see, when you look at the US has had this fundamental advantage where early stage investors start selling their shares much earlier in the journey, and this creates people to reinvest that capital into the ecosystem back again. This could be angels, this could be employees, this could be early stage investors. And so because of the liquidity circle closing, get the gap, you're getting a lot more companies also coming up, and thus the whole ecosystem kind of thrives. Whereas in Europe, this has been a fundamental challenge because of regulatory reasons, because of the fact that people had a different view on secondaries as money out of the company. Now that a lot of capital has chased these businesses and you're seeing material value, and especially with more foreign capital coming into European companies, the need for secondary markets is growing massively. And I'm really happy that Nasdaq is doing this as well, because you see a lot of this material value being created, and not all companies need to go public. And so we are seeing this where we are trying to clean up cap tables and align the interests of the investors who are on the cap table for that longer term growth, while ensuring that liquidity is provided to the key employees or the key investors who came in early in the journey. And at the same time, what we're also trying to make sure is that founders themselves realize a bit of the value that they've created, because this then gives them further impetus to kind of grow the value company. On a question about does every company need to go public, well, there are pros and cons of both, right? But it does raise the profile of a business quite internationally. So it does help the business in many respects. But then again, if there is a active secondary market for this, then businesses can tend to stay longer, private for longer. So I'm seeing both drivers happening in the market parallelly. Obviously, as IPOs are being kind of pushed to 23, 24, the secondary market will take a bit of more momentum over the next couple of months.
Cool. Good. You know, this is a topic we could talk about forever. Would you believe we're almost out of time? We've got 5 minutes left. Because it is in the title, Impactful Investments, I do want to just, like, as quick as we possibly can, impact investing, right? Ash, we talked about this on the phone. We heard a lot about impact investments over the past 2 years or so. I mean, Anna gave us the term pink washing this morning, right? So I just want to make sure that we're not, you know, impact investment is just not a greenwashing 2.0. What are your thoughts on deep tech investing? Because, as I said, it's a topic near and dear to my heart. These are investments that, you know, are extremely long haul. LPs market is the, you know, does this strategy have legs? Is it something that can be a win for Europe? What are some of the barriers that are preventing even more deep tech? I know those are 5 questions all in one, and we've got 5 minutes to wrap this up. Tugce, I know you want to answer this one. Go for it.
Oh, so many questions in there.
So
yeah, you're right. I mean, there has been some greenwashing. I have seen so many startups and funds as well trying to put some impact sustainable angle in their stories, because there has been so much funding out there for it. There's so many investors that want to tick that box. But I do think that there are also a lot of meaningful companies out there. And for example, like most of my investments are B2B SaaS enterprise. We look at deep tech as well. And with my fund, I don't necessarily say that I invest in impact or sustainability, but the companies I invest in, they are around sustainable consumption and production, because we're talking about a more efficient use of resources. We're talking about being less wasteful. We're talking about speeding up supply chain processes, etc. So I do think that Europe, especially, will have a very special place in the new impact sustainability investments world because of the Green Deal, etc. We're going to see so much digital transformation happening in old economy. Europe is the heart of old economy. We're already seeing so much positive disruption by really cool deep tech companies in manufacturing, retail, logistics, shipping. And again, as I said, supply chain, because I really look into that area. So all of those technologies might not necessarily be impact investments per se, but because of the efficiencies they create, they are one. I don't know if I answered your question correctly, but...
I think it does. Adam, I know you've got an opinion here.
Well, first of all, if you need to have an impact story, or you need to be able to tell what impact you're making from an ESG perspective, long-term perspective. And the stakeholders are not only investors, it's also employees. The stakeholders are many. It's your customers and everything. So you have to have your stories straight. I think if you see what's happening, a fundamental shift in the public markets, there's more and more money focusing on ESG and impact investing. So as a public company or as a private company getting ready to go public, know how to tell your ESG story, start tracking it, start measuring it. And we need standards that companies can live up to, which are clear and measurable, so that it's not a vague terminology in terms of what impact is or what ESG investing is. So I think those are fundamental aspects. What we at Nasdaq are doing is now focusing on how do we help companies manage these investor demands. So one of the investments that we've made is we acquired a majority stake in a company called Puri. And Puri basically helps companies carbon compensate in a credible way. So you understand where the source is coming from and that you're doing this actively. And so what we need here is not companies doing this on a voluntary basis, but doing this in a really significant way, in a structured way, and we need more and more demand from the customers that companies are doing this. So we are aiming at basically doing these kind of investments, helping companies manage the increased investor demands. So I think overall, impact investment is not a nice to have, it's here to stay, and I think especially for a private company thinking of going public, if they think that they can access impacting money outside the public markets, for sure, there's a lot of money, but there's even more money in the public markets that is now geared on focusing on investing on ESG and impact. Okay. So key to have that story straight and told in a clear way.
Ash, you ready? You have 1 minute to sum up the 20-minute conversation that we had a few days ago. Hit it.
So very quickly, we are a growth investor, but we're also an impact investor. Two fundamental points to think about, right? Impact has a different definition in every part of the world. What is impact in Africa is very different to impact in Europe, which is different to impact in the United States. Which is why, as a fund, when we look at impact, we put it into 3 different buckets, which is people, planet, productivity. So if we're looking at a software business, we try to measure what is the impact it is creating out of the productive benefits that this software brings to what it does. And as a result, what is the kind of net gain? So we call this sustainable capitalism. This is something which has been part of our DNA, but what we're trying to essentially do is we want to make money, but at the same time, we want to make sure that the company we're investing in is doing some materially good work. We were discussing earlier, Adam, about a company which we both know about called Neo4j. It's a database business which came out of Sweden, but today essentially is present pretty much across the world. And this was the very company which was used by Pfizer for distribution of COVID vaccines. So one could look at it as this is a database business, but at the end of the day, what it essentially does is helping improve productivity. So impact is very broad as a word, and to measure this, we use KPIs, which are derived from the operational metrics, so that we are able to report materially, quantifiably, what this company is actually doing. And the interesting bit is now even LPs are starting to request for this. There's a big talk about impact-linked carry, because if we have to make this real, there have to be incentives which are aligned to that. And thus, I think the movement is coming where more and more GPs would be committing to some certain practices to make investments which actually provide or do something positive through the investments.
There we have it. Ladies and gentlemen, like I said, I feel like we could talk about this for another 3 hours. These have been my panel. Thank you very much. Join us later.
Thanks.
We'll be circulating around. I'm sure you can grab one of these folks and have a chat with them.